So as you guys may know, or some of you guys may know a little bit about me, real estate is my second career. I got into real estate back in 2018 after retiring from the NFL. And it was really my red pill moment to pivot into a world where it allows me to get the time freedom and the cash flow that I really wanted to. And transitioning into anything professional outside of sports can be challenging, but fortunately for me, my background is in real estate private equity, and officially went full-time in real estate syndications back in April. And so our portfolio is primarily based in Baltimore City, but we're currently looking at other opportunities in other markets and expanding our portfolio. So how to evaluate a sponsorship, right? As I mentioned, it's very, very challenging to figure out who's who in this industry because you have a lot of different things that you have to kind of vet and understand to really understand if this is a really good deal for you to invest in, right? So how do you evaluate a sponsorship team to make sure that you're investing your capital the right way with the right operator? So the first thing you should be looking for is sponsor risk, right? And how I define this is, what is the experience of the operator? Does this person know how to operate the particular investment that they're bringing to you, right? Do they have the experience doing a value add opportunity? Do they have the experience executing the business plans? All of the things I think people really need to ask when they're talking to potential partners, because it can be easy to get into deals and you get down the road 6 months, 12 months down the line, and that person isn't what they said that they would be, right? So really hunkering down and figuring out what is the risk within the sponsorship team is probably one of the biggest risk factors that you should focus on when you're looking at these opportunities. The second thing, like I mentioned, is business plan risk, right? Is this business plan too aggressive? Are the rents too aggressive to get out of the deal, right? From a cap rate perspective, a lot of operators, I think, have been relying on rent growth to make these deals pencil over the past maybe 12 to 36 months. But I think, those tailwinds in the multifamily space are going to calm down a little bit for the next 12 to 24 months, given the fact that we're already seeing some flattening in the rents in today's environment. The third thing is financial risk, right? So, is my capital at risk within this deal? Like how leveraged am I in this deal to be in a position where your capital is lost? And the biggest thing when I look at any deal that I'm investing in, whether small or large, is what is my return of capital rather risk, right? Definitely important when you're looking at deals, because you want to make sure that you're getting your capital back first and foremost within any investment opportunity that you invest in. Another risk is asset risk, right? Are you investing in a deal that is maybe a Class D property, right? That has a ton of collections versus a Class A property that is likely going to have a much, affluent tenant base, right? I think asset risk is something that's really important, because especially in the C-class markets where a lot of syndicators tend to start off, you see maybe a much more delinquencies and much more management intensiveness in those properties, as opposed to a higher class property like a Class A or an A- property located in a core market, primarily due to the tenant base and also the product type as well, right? Age has a lot to do with operations from an intensiveness perspective when you're looking at asset risk as well. Another risk is market risk. This is, what I call from a large market perspective. When I say a market risk, I'm talking about, let's say Baltimore, Maryland, for example, right? I know in my market, we have great jobs, what we call feds, eds, and meds, government job, educational job, medical jobs from a market perspective. But a local sub-market might be a little bit more risky because that market might not have access to those jobs, right? So definitely looking at things from a market risk perspective is extremely important, as we know that jobs ultimately drive real estate. And similar to market risk, location risk is what I call a little bit more on the sub-market level, right? So you might have a market in Baltimore, Maryland that, like I mentioned, has great jobs, but the location of the actual asset is not in a good area. So all of these 6 things I think are a good culmination of what you should be looking for when you're evaluating a sponsorship team, because it's imperative to have a criteria of how you screen your opportunities to make sure that you're, preserving your capital. All right, so key metrics to monitor. So when we talk about key metrics to monitor, what are the metrics that you need to be looking at when evaluating deals moving forward, given the fact that the Fed has increased rates, I think about 6 times in 2022. There's some market dislocation on where prices are versus where debt is versus where prices are today. I think debt has risen at a velocity that has not expanded as much as cap rates have in today's environment. So you really have to figure out, what metrics should I be looking at in today's environment? The first thing, as I mentioned, is rent increases, right? When I look at a pro forma, the first thing that I like to do is bring all of the rent increases down to 0. The reason is because a lot of times rent growth drives your pro forma, right? So if I'm looking at a pro forma and an operator sending me a value add opportunity that has trended rents, year over year. So when I say trended rents, meaning that year over year, there's an increase in rents to maybe, 3-5% year over year, that has a direct impact on the NOI to get to that terminal cap rate, right? That end cap rate where the property is going to be valued, and ultimately you're going to waterfall down to your sales proceeds. So I think rent growth is really important, rent increases, because when you turn that down, now you can actually dig into the pro forma and see at a granular level, how are we getting to the profitability in this deal, minus the rent growth that the operator thinks that he can get, or he or she can get. Really important there. Cap rates are another one, right? So when you're looking at the cap rates, as I mentioned, we don't know where cap rates are going to be in the next 12 to 24 months, right? One of the challenges that I think people may have opportunities in within the commercial real estate market within the next 12 to 24 months is that we have a ton of CMBS debt that has maturities within the next 12 to 24 months, right? And so what they're going to have a problem with, given the fact that rates have jumped up and credit markets have pulled back a little bit, is they're going to have problems with achieving their debt service coverage ratio to get the liquidity that they want to actually maybe refinance or get into another product. So I think from a cap rate perspective, you really have to know how important debt contributes to that terminal cap rate value, because if you're looking at deals that have the same cap rate as where rates are today, you're going into negative leverage, right? And so if the Fed continues to increase rates, then you're probably going to have a tough time getting to that terminal cap rate if you didn't already account to some basis points expansion on the back end to get into a conservative underwriting for your deal. Interest rates, another important thing, right? Debt is likely the biggest killer of any real estate deal, right? So if I'm looking at a property that has bridge debt today, I want to make sure that the operator knows exactly how they're going to get out of that bridge debt in the next 12, maybe 24 months. As I mentioned, the capital markets have pulled back a little bit, and people are going to be maybe in some trouble when they're thinking that they're going to refinance at one value, but the value is going to be something different. And also the interest rate has an impact on your cash flow as well. Excuse me. So I think that's important when you're looking at deals from an interest rate perspective, is making sure that the operator knows exactly how they're operating in today's environment and where they think rates are going to be on the back end, especially for the next buyer, as well as they plan to dispose the asset maybe in the next 24 to 36 months. Okay, the next one is debt yield. As I mentioned, this is just this is similar to what I mentioned on how a lender is going to look at your loan and decide whether or not to fund your loan based off of specific leverage. It's similar to the type of debt that you're actually going to get on maybe a takeout loan when you're getting a bridge loan and converting that to a permanent loan. The lender is really going to take a look at this to figure out how they're going to size that loan. So again, if you are not in a position going into the deal where you're underwriting conservatively and you're not thinking about all of these factors, this is something where you're going to be set up for failure when you're trying to maybe refinance the property into maybe a favorable debt structure that you thought that you would when you're looking at these deals. So I think these 4 key metrics are internal metrics within a pro forma that when you actually look at them on a granular level and figure out how it actually ties to the actual entirety of the pro forma, this is something that you really need to pay attention to because it's going to have a direct impact on the profitability of your deal. Okay. So is the deal a good deal for you, right? Does the deal actually work for you? A lot of times we might have different investment appetites, but you really have to figure out, like, does this deal actually work for me? And the first thing obviously is risk, right? What is the risk on the deal? All deals obviously have risk, but your goal should be to mitigate your risk as much as possible. How we look at deals, especially in today's environment where there's a lot of volatility and price dislocation, is figuring out how can we, number one, preserve our capital, excuse me, and then focus on downside protection when underwriting these deals to make sure that we can actually hit the numbers that we talk to, that we want to when we talk to investors, right? So risk is obviously your number one thing when you're looking at opportunities and should definitely be important. Capital reserves, right? Does this deal actually erode your capital reserves because we might be going into a recession, right? We don't know what's going to happen in the next 6 to 12 months, but you want to make sure that you have enough capital reserves. Maybe you're doing something personally, or you need to fund something. But, my number one goal when I talk to any of our investors is I make sure that they're never investing the last of their capital, right? Because that's not someone that you want to actually invest with, because you never want to put someone in a position where they're down to their last. So another thing is your returns, right? What are your return expectations for a deal that makes sense for you, right? Are you more on the aggressive side? Are you looking for something that is a higher return that might have a little bit more risk? Or are you looking for a core deal where you might be okay with a 2 to 3, 4% return year over year, but you know that your asset is safe, right? So understanding the risk versus return is certainly important when trying to figure out, hey, does this deal actually work for me? And your business plan execution risk, right? Are you okay with stomaching some of the things that happen when you're doing value add opportunities, right? That might be a situation where you might get into a deal and you thought that you were going to have X amount of vacancy for the first 12 months, but you got into this deal and you understood that this entire tenant profile is spotty on rent collections, right? So now you're going to have to deal with turning over the property and maybe getting to some occupancy that's not necessarily favorable, but certainly business plan and risk is certainly important. because you have to know that sometimes these deals don't go according to plan, or if you know that the deal is going to be a little short on the front end, let's say maybe 2-3% on the front end for the first 2 years, but as the operator executes the business plan and gets into year 3, then that cash flow might jump to a 10% or an 8%, So definitely understanding your business plan execution risk is extremely important. So I said that I was going to go for about 30 minutes or less. Generally, we do these short webinars, and then we open it up for about 10 to 15 minutes for questions. Last week, we had a ton of questions. We had a great crowd last week. And again, I apologize for the technical difficulties on the webinar today. And I'm definitely happy to have more questions and dialogues about the multifamily market today. Let's see. So. All right. So I just opened it up for questions here. Any comments? Let's see, I had this. Love to talk more. If anyone has any questions or comments about the state of the multifamily market or anything that's going on in the multifamily space, happy to have the conversation. James, good to see you. Haven't seen you in a while.
Yeah, man. Nice seeing you again, man. Yeah. But I do have one question though. You mentioned earlier smaller. What I'm looking at are 20 to 50 units. 20 to 50 units. So what do your company love to look at? What size?
So generally, we're looking at least around 80 units right now, because that's where you kind of start to afford some scale on your properties. We'd look at a 30 or 40 unit as well, but generally we would like that to be in an area that we already own, because we get to share management expenses and XYZ. We wouldn't go to a place in, let's say, Virginia and do a 20 unit deal or a 30 unit deal unless someone was already boots on the ground there, right? That can handle the value add management from a day-to-day basis. Maybe they're doing the construction management, or they're overseeing the construction manager and being the asset manager with boots on the ground. But I think the scale aspect is really, really crucial when jumping up into or just looking at deals, because the smaller deals take a lot of time and energy to work on. And when you have a larger opportunity, you actually get to hire people, right? And have those resources to go out there and execute on your behalf, so you can focus on maybe growing your company or doing more and more deals.
Okay. So you mentioned Baltimore. So you basically in Baltimore?
Yeah. All of our properties are in Baltimore right now. And so, our goal is to expand out into other markets, south, along the South Corridor, down 95 in particular, all the way down to Florida. And, we're actively looking at any opportunities. So I know we haven't chatted in a while, but would love to reconnect and see what you're working on.
Good. I would love that. Give you a call tomorrow.
That sounds good. Does anyone else have any comments, any questions about anything? Would love to chat a little bit more.
I do have a question. So I understand like when you get to the larger properties, you want to, definitely want to scale. You have a better chance of scaling. So what type of return are you looking for, like apartments that have, like 100 units and up?
Yeah, so generally we try to underwrite to a 15 IRR, and after that, we try to change the promote structure where the sponsor is compensated. I think industry standard, quote unquote, that might be a little um uh somewhat, I want to say anecdotal, but I would say a lot of operators try to underwrite to a 15, and then the pendulum on the promote just swings a little bit, but generally we like to see 15 IRR at least over 3 to 5 years, and we try to get our retail capital investors to see maybe a 10 to 12% average cash on cash return, not including the sale proceeds. So when including the sale proceeds, we might get to about 20% year over year or so. So ultimately our goal is to double our investor capital in 5 years or less. And that's the types of deals that we try to look for.
Okay. Thank you. Thank you so much.
All right. Any other questions or anything? Comments about anything that I mentioned, maybe about sponsor risk or just looking at opportunities today? All right. Well, guys, I really appreciate it. Appreciate the time. Again, I apologize for the technical difficulties. That definitely was not planned. And we're having this every week, generally on Thursdays. So last week was great. This week was great. Next week will be even better. So definitely would be excited to see you guys back again for next week. So take care and happy holidays.
All right.
All right, Sam, you look forward to seeing you
Happy
next week.
holidays.